Hi there, I'm Neil Dickey. Welcome to this pension technical video on the annual allowance. The annual allowance is effectively a limit on pension contributions from all sources, as well as increases in pension benefits in defined benefit schemes over the course of a tax year. The annual allowance works separately from the annual limit for personal tax relievable pension contributions, which is an individual's relevant UK earnings. This means it's possible for an individual to breach either or both, depending on their income position and their available annual allowance. The annual allowance was introduced in April 2006 as part of the pension simplification reforms and was originally set at £215,000, rising gradually to £255,000 in 2010-11. In April 2011, it was then reduced significantly to £50,000. At the same time, to aid those who tended to make large one-off contributions, the ability to carry forward any unused annual allowance from the previous 3 tax years was introduced. But that's a topic for another day. In 2014-15, the annual allowance reduced again to £40,000 and was set to remain at this level. However, as a result of the July 2015 budget, under the transitional pension input period rules for 2015-16, this doubled to £80,000 for the pre-alignment tax year, which ran up to the 8th of July 2015, and then a maximum of £40,000 for the post-alignment tax year, from the 9th of July 2015 up to the 5th of April 2016. Subject to £40,000 or less being contributed in the pre-alignment tax year. Care needs to be taken to not simply compare the total contributions paid against £80,000 for this tax year. The annual allowance applies to any pension contributions made by or on behalf of the individual it relates to, as well as the increases in the capital value of pension benefits in defined benefit schemes. The aggregate of these are known as the total pension input amount. The exceptions to this are any contributions paid at or after age 75 and personal contributions that are not relievable. Pension credits resulting from divorce and any investment growth are also ignored. The annual allowance does not apply to a pension arrangement in the year of death or to any arrangement in the tax year when the benefits are taken on the grounds of serious ill health. For active members of defined benefit schemes, all increases in the capital value of the member's pension and tax-free cash benefits are included. This is calculated as 16 times the increase in the member's annual pension after allowing for inflation as measured by the Consumer Prices Index, CPI, for the 12-month period to September preceding the tax year in question. In 2015-16, however, a fixed figure of 2.5% was used for CPI. Deferred members who left in a previous tax year will generally have no accrual to be considered for a future year. Prior to the budget announcement on the 8th of July 2015, the total pension input amount related to the pension input period ending in that particular tax year for each of the members' pension schemes that was tested against the annual allowance. The pension input periods did not have to end 12 months after they started, and they could have ended on any earlier convenient date as chosen by the scheme administrator or the member. The sole exception to this was for defined benefit schemes, where the decision lay with the scheme administrator only. With the transitional pension input period rule changes for 2015-16 introduced on the 8th of July 2015, this has changed, and from the 6th of April 2016, all pension input periods are aligned with the tax year, and it is now no longer possible to change this. If the annual allowance is exceeded and the amount of the excess is not covered by the carry forward of any unused annual allowance, then the excess will be subject to the annual allowance charge at the individual's marginal rate of income tax. On the 6th of April 2015, the government also introduced the money purchase annual allowance, and it's worth noting that carry forward cannot be used to deal with any excess where it is the money purchase annual allowance that is exceeded. The excess, less any carry forward, must be input into the member's self-assessment or notified directly to HMRC if they do not complete one, and the charge is usually collected as part of their taxes due. However, where a member's annual allowance charge on this excess exceeds £2,000 and the total amount of the member's pension savings in a given pension scheme for the same tax year has exceeded the standard annual allowance, then the member can ask that scheme to pay the annual allowance charge that relates to the excess above the standard annual allowance out of their benefits. The ability to require the member's pension scheme to pay the annual allowance charge does not apply to when the money purchase annual allowance or the tapered annual allowance is exceeded, unless again the annual allowance charge exceeds £2,000 and the total amount of the member's pension savings in the pension scheme for the same tax year has exceeded the standard annual allowance. Thank you for watching.